G'day folks, it's Jim here from Orchard Forex on Monday the 10th of February with a weekly outlook into possible trading strategies. Going back to Friday, the dollar finished stronger and stocks a little bit weaker following the mixed unemployment report, where although the non-farm payrolls was a good number at 225,000 I think it was, the headline rate and the average hourly earnings both came in slightly below expectations. The dollar overall liked the data, but stocks were unable to make any gains. But I think this was really more likely due to some weekend profit taking and cautiousness in case of an escalation in the coronavirus. And this scenario, it does look as though it can carry forward into Monday. And given the relatively light calendar this week, it would appear that the virus and political headlines are going to drive the agenda over the next few days. So anyway, with that said, we'll go and have a look at the charts. I thought I'd start with my trend table that I use and made up this morning. And as you can see, where there's consecutive coloured boxes, possibly developing a bit of a trend. So the euro looks heavy on the 1, 4 and 4 hour charts and the dailies. The Aussie and the Kiwi both look still look very heavy in the longer term. Sterling looks as though it's going to follow the lead of the euro. Dollar Swiss looks slightly big, but dollar yen, as we'll see in a minute, is not really doing an awful lot. It's struggling to get above good resistance. The dollar index here looks to be headed higher on all fronts, and the S&P looks a little bit heavy. Although the ASX currently doesn't look very directional, but I can't think that it's going to be heading an awful lot higher if the coronavirus continues. As far as the crosses go, well, they're all pretty messy. I wouldn't look too much there. I think overall we're probably looking at a dollar move. And with that said, I'll have a go. This is the dollar index. Now this is a daily chart. And as you can see, we've had some pretty good rises, 1, 2, 3, 5, 6 rises in consecutive days. The MACDs do look pretty big, and now that we're above this previous high here, 98, sort of 50, 55, I think that should act as some minor support ahead of the more major level down here around sort of 98.40, which was the previous 61.8% move back up from the whole down move. So if we do continue higher, the next port of call is going to be this sort of 98.88 level. That's the 76.4% retracement, and then of course we can go back up here to this 99.67, which was this high seen here in October of last year. If we go and have a look at the weekly charts here, they do seem to be turning higher as well. So overall, I do like some further upside in the dollar, albeit I don't think it's going to move fast. I think it's going to be a fairly steady move, but I think there's possibly plenty more in it. Now we'll go and have a look at the euro, if I can find that somewhere. Okay, now the euro's been interesting. We've had this head and shoulders that we were watching, and basically we've come down to more or less meet the expectations of the break here. We've come down here, although the 4 hour charts are moving lower still. They are becoming a little bit oversold, so we could see some consolidation today. But as we move further out, that white line there is the neckline I've been looking at as that head and shoulders, and now we've broken well below it and reached the objective. I'm wondering if we've got an even bigger degree of head and shoulders here. So if we get rid of the white line, yeah, and use the red line here as the neckline, in that case we've got an awful lot on the downside as potential still. Now that would that's going to take us down to that 107.40 level, which is this long-term trend line, which I'll show you on the weekly charts. But really, I think we sell rallies now. You'd certainly keep a stop loss tight above this 109.90 level, call it 110. If it goes back above there at any stage, the head and shoulders, the larger head and shoulders becomes invalid. But in the meantime, selling to rallies, looking for an eventual move back down here. Now, because this is a daily chart, there's no real expectation of this happening this week. But I think we could see a slow grind lower. The indicators are generally still looking heavy. And if we go out to the weeklies, you can see where I'm calling this trend line here, which covers these bases for the last sort of 3 moves. So 107.40 is basically where I'm looking at. The weeklies, I have to say, are looking pretty neutral at the moment. They're not showing us an awful lot. The RSIs and the stochastics are pointing a little bit lower, but I think this is a move that is going to take its time. But anyway, something to keep an eye on. Dollar yen did finish a little bit lower. The yen saw some safe haven demand. We were unable to get above this 110 level on Friday. And beyond that, that's the 110.20 level we seen up here. I think it's 120 or 110.30 or so. Right now, as long as there's safe haven demand, which is going to be ongoing because of the coronavirus, I think probably avoid dollar yen. But I think you can look for levels to sell euro yen, Aussie yen, sterling yen, Kiwi yen. I think the downside probably has some leeway there, although the crosses have been very choppy. So I think this is probably a dollar move, which is why I'd avoid dollar yen. Sterling, I see there's some more Brexit headlines this morning about how the EU are going to make it tough for the UK. Now, once again, I'm not sure if this is a head and shoulders or not. But if it is, with the head up there, we've got the couple of shoulders. There's plenty of downside here. This takes us back to a target of 125. Where is it? 122.5 basically. So there's plenty of room to the downside there. We're sitting on support at the moment at this sort of 128.75. We've got the 200 days just under 127. But the dailies are beginning to point lower. The weekly charts are not really doing an awful lot at the moment, but they may be drifting slightly lower. But I do like the idea. I'm actually short a little bit of sterling, not an awful lot, but I am short. I sold it on Friday on a break of the neckline, and yes, I do think we've got more downside ahead. I won't bother with dollar Swiss. That's too hard. The Aussie's interesting. Now the Aussie made, actually we need to go to the weeklies, the dailies and all. The Aussie has made a new 10-year low. It hasn't been down here since 2008, 2009, somewhere around there, where we're trading at the moment. So the weekly's pretty neutral, but they may be turning a little bit lower. Now, having not been down here since 2009, there's not an awful lot of support here, and if we need to really go out to the monthlies. Let me just blow that up a bit. We need to go out to the monthlies, and as you can see, there's not an awful lot of support on the monthlies until we reach sort of 62.40 or so. Now that's obviously some way away at this stage, and it's going to be a slow process. We've also got some bullish divergence here. The MACDs and the RSIs, they're not as low as they were for the previous move. So I don't think it's going to be easy, but I still think selling rallies is going to be the way of it. Particularly, we'd like to see some pretty poor data coming out of China over the next couple of months. That's not going to help the Aussie. I think the RBA are going to have to cut rates. I'm kind of surprised they haven't already, but I think April and the banks are talking April and August for rate cuts. So I think selling rallies into the Aussie is the way to go. Kiwi, much the same. We've got the RBNZ on Wednesday. No change to policies expected there, but the Kiwi on the daily charts, it broke 61.8% of this squeeze higher. Broke that on Friday, and so now I'm looking for a move back down here to the next FIBO level, which is about 63.35. So that's about 65-70 points away. The dailies are pointing lower. Once again, the weeklies are not doing a great deal at the moment, but I do think I think their time will come, and I think the Kiwi remains pretty heavy. Dollar China, which I don't really follow all that closely, but it's worth noting that dollar China is currently back above 7 today, which will put added pressure on the Aussie and the Kiwi. Okay, so that's about it for the currencies. I'm not going to bother with the crosses, but we'll go and have a look at the stock markets just quickly. Okay, so here's a 4-hour chart of the S&P. It's looking pretty heavy on the 4-hour charts, I have to be honest. I think it's going to be a brave man to buy it today. So with the coronavirus sitting in the background, so I think there's potentially further downside. The dailies, we made a new high, all-time high up here, but as you can see, there's some pretty substantial bearish divergence. So I prefer the short side, and I think that there is plenty to go on the downside. The weeklies are also very overbought and appear to be turning lower. So it's been very difficult to try and sell the stock market because it's bounced back every time. But just for the time being, I think it's probably the way to go. But and you know where your stop loss is going to be. Really, this all-time high here, 33.56. So you keep your stop loss above 33.60, and you should be okay. If it goes above there, well, I've got it wrong. The Aussie stock market is looking pretty heavy as well. That's a 4-hourly chart, and I think it wouldn't really surprise me at all to see us come back down here to the 100-day, the 67.50, maybe the 200-day at 60. What's that? 67.50 and 66.40. So that's going to be some way off, but it looks to me as though the dailies may be heading a little bit lower. They're not doing a great deal, and the weeklies are pretty neutral as well. So, but once again, the RSIs and the MACDs are bearish divergence. Bit of a warning signal, I think, but this is a weekly chart, so it's going to take a while to iron itself out. Gold and silver, too choppy. I leave them alone. What else is there? Oil's interesting. It's now it's back below 40. It's back below 50, I should say. It closed the weekend above 50, so it means we've had a little bit of a gap on the opening. Yep, there we go. But we're still sitting above the support here seen last week. What's that? 49.25 or so. Not quite sure what to think here, but if the coronavirus continues to motor along, then the upside for oil is pretty minimal, and I'm looking for a move down here to this sort of 48 target, which is a FIBO level, and if in a worst case scenario we could head back down here to sort of 42, which was the low seen what's that, Christmas Eve 2018, so that's a while ago. I would be looking to sell rallies, but if it got back above here, 52.20, or ideally above sort of 53.25, I'd have a stop loss place there. So that's about it today. There's plenty going on. It's a case of, I think, buy dollars, sell stocks, sell oil into rallies, and probably leave the crosses alone. But if you want to play the crosses, I would be long the yen, maybe long the Swissy against the other majors. So that's about it. And we'll be back next week with another weekly outlook. Cheers. Catch you later.